How Warren Buffett stays calm when the stock market crashes. Imagine opening your investment account one morning and seeing something that makes your stomach drop. Your portfolio is down 20%, then 30%. The news is getting worse. People are predicting a recession, a financial collapse, or the end of the bull market. Most investors start thinking about one thing: should I get out? Warren Buffett tends to ask a completely different question: what has actually changed? That difference explains a huge part of Buffett's investing psychology. Buffett doesn't stay calm during market crashes because falling prices feel good. He stays calm because he has trained himself to separate the price of an asset from the value of the underlying business. Think about it this way. Imagine you own a small business that produces $1 million in profit every year. One morning, someone offers you half as much money for the entire business. Has the business suddenly become half as productive? Not necessarily. The price changed, the business may not have. That's one of Buffett's most powerful mental advantages. When the stock market falls, he doesn't automatically see a disaster. He sees a market where prices have changed, and then he asks whether those prices create opportunities. But here's the part beginner investors often miss. Buffett's calmness is not simply courage, it's preparation. He understands the businesses he owns, he maintains financial strength, he thinks in decades rather than days, and he accepts something most investors struggle with: uncertainty is unavoidable. He doesn't need to know exactly when the market will recover. He doesn't need to predict tomorrow's headline. He needs to know whether the underlying investment still makes sense. And that gives us a powerful framework for surviving our own market crashes. Call it the crash test. When your investment falls sharply, don't immediately ask, how much money am I losing? Ask 3 questions. First, has the business fundamentally deteriorated? Second, did my original investment thesis become wrong? And third, am I reacting to new information or simply reacting to fear? That third question is brutally important because markets don't just test your knowledge, they test your temperament. You can understand compound interest perfectly and still destroy your returns by selling quality investments in moments of panic and buying them back after confidence returns. And there is another Buffett lesson that beginners sometimes overlook. You don't need to imitate Buffett's portfolio to imitate his psychology. You probably don't have his capital, his access to businesses, his insurance operations, or his decades of experience. But you can imitate his discipline. Build an emergency fund so you aren't forced to sell investments when life gets difficult. Avoid excessive debt and leverage. Invest money you genuinely don't need tomorrow. Diversify appropriately. Understand what you own. And most importantly, decide your rules before the crash arrives. Because it's much easier to say, I will remain rational during a 40% decline when your account is growing than when you are watching thousands disappear. A market crash is therefore more than a financial event. It's a psychological examination. It reveals whether you are actually investing for the long term or simply hoping prices will keep rising. And here's the Buffett lesson I think matters most. The goal isn't to become someone who feels nothing when markets crash. The goal is to become someone who can feel fear without allowing fear to make the decision. Because when everyone around you is staring at the price, the real advantage may come from having the discipline to look underneath it. The market can tell you what something costs. It cannot automatically tell you what it is worth. And learning to recognize that difference may be one of the most valuable investing skills you ever develop.